Hello and welcome to the Daily Brief Show. Today is Tuesday, the 10th of September, and I have four very interesting stories for you. In the first story, I'll talk about India's big semiconductor dreams. In the second one, I'll talk about some forex scams that are happening in the market today. In the third story, I'll talk about how the global oil market is currently positioned. And in the fourth story, I'll talk about India's big dreams with corn as a fuel. So let's begin by talking about the first story, which is India's big semiconductor dreams. Look, India and Singapore recently signed an agreement to collaborate on semiconductors. But what does this partnership really mean for India's ambition in the chip industry? Let me break it down and also explore the broader context of India's semiconductor journey. But before that, let me explain what exactly semiconductors are in the first place. Look, semiconductor chips are the brains behind all electronic devices essentially. They process information, store data, and essentially control how devices work. All things like smartphones, computers, cars, appliances, etc., are essentially controlled by semiconductors. Semiconductors are the reason why our modern electronics are capable of being smart and performing complex tasks. Now, even though Singapore is a very small country, it is a very big player in the semiconductor space, and Singapore has a very well developed ecosystem. This partnership is a very crucial step in India's ambitious journey in order to grow its own semiconductor capabilities. I'll tell you more about what is happening here. See, first, Singapore will support India by training Indian workers in very critical areas like chip design and manufacturing. This will help India build a skilled workforce that is essential for the semiconductor industry. Second, the hope is that the partnership will lead to investments from Singapore tech companies that can help kickstart India's chip ecosystem. Third, 10% of the global semiconductor output is produced in Singapore, and pretty much all the major semiconductor companies have a presence there. With this agreement, India hopes to leverage these very networks in order to attract investments and leverage their experience. Now, it is important because India has ambitious plans for the semiconductor industry, but the reality is that we are still in very, very early stages. In fact, we don't even manufacture semiconductors much. So far, we are only involved in outsourced semiconductor assembly testing, or OSAT, which in other words is testing, assembly, and packaging of semiconductors. We are not involved in manufacturing yet, if you think about it. The only exception here is Tata's PSMC fabrication facility, which is planned in Gujarat. This facility aims to be India's first real semiconductor fabrication facility. It is a massive project with an investment of over 90,000 crore rupees. But India will need to overcome some major hurdles before this project becomes a reality. But in order to understand exactly how difficult it is to enter the semiconductor manufacturing space today, it is very important to look at the global leaders. TSMC, or Taiwan Semiconductor Manufacturing Company, is the world's top chip maker with about 53% market share. Samsung, Intel, Global Foundries, and SMIC are the companies that follow behind. Now, all of these companies have decades and decades of experience, established ecosystems, and have massive investments. Even Intel, which is one of the biggest names in the industry, has struggled to keep up with TSMC despite being a leader in chips. So if you think about it, if Intel, with all its resources, experience, expertise, and long history, has struggled to adapt to the changing semiconductor landscape, how can India, which lacks all of this, can succeed? Building a chip making industry from scratch is immensely difficult, and it requires deep understanding of complex manufacturing processes, a skilled workforce, and a massive ecosystem of specialized suppliers and partners. All of this takes years, if not decades, to develop. TSMC has been building a manufacturing plant in Arizona, US since 2020. It was originally set out to start manufacturing chips in 2024, but it was pushed to 2025 because of cultural differences, labor issues, and technology transfer issues, among all other things. Now, back to India, our initial focus on chip packaging facilities is in a way a good starting point. First, it is less capital intensive because chip packaging is less complex and less expensive than full-scale chip manufacturing. Second, it can help India slowly build the necessary expertise and infrastructure required to get into full-scale chip manufacturing through knowledge transfers. Third, this provides a good foundation for India to go deeper into chip manufacturing, and this might attract investments for more advanced manufacturing capabilities later. But that said, moving from packaging and testing to actual chip fabrication is a very complicated and different game. According to a report by BCG, Semiconductor manufacturing is heavily dependent on global supply chains, specialized knowledge, and vast capital investments. And all of this, as I mentioned earlier, India needs to develop from grounds up. Even with the right strategies and support, there is no denying that India's path to becoming a semiconductor hub is going to be filled with challenges. The collaboration with Singapore, government initiatives, and private investments are steps in the right direction. We'll see how this turns out. In the next story for the day, I'll talk about a mega trading scam yet again. Look, in recent times, the rise in investment and trading scams in India has been alarming. People have been losing thousands and crores of rupees to these scams. Just in the last couple of months, scams worth 10,000 crore rupees have been exposed in just one state of Assam. All of these are just the ones that have been reported, by the way. Imagine how many more there might be out there which are unreported and unknown. One of the bigger scams going around nowadays is illegal forex trading platforms. According to the Economic Times, the Enforcement and Directorate or ED recently banned dozens of scammy forex trading platforms that were involved in money laundering. This scam was worth over 10,000 crore rupees. But this is not the first time ED has busted a forex trading scam. This year itself, they have already taken down several scams across the country. But what is most shocking here is how these fraudsters operate. They just don't set up shady forex websites, they build entire fake ecosystems. I'm talking about fake e-commerce websites, scammy forex platforms, and illegal payment aggregators as well. And this is all just not a local operation. These scams have also links to international networks in places like Spain, Dubai, Russia, and Pakistan, etc. So the big question here is, how did these scams go undetected and unnoticed for so long? Look, the answer lies in how sneaky these scammers are. They don't just put together a few fake websites, they instead create entire networks of shell companies. They open multiple bank accounts under fake names and even hire ex-bank officials to help them launder money. Some of these platforms open new bank accounts and change their UPI IDs regularly in order to keep the money flowing, even if one of the accounts get flagged or blocked. Take OctaFX for instance. This platform has been at the center of many scams, and they have even hired Bollywood stars and famous cricketers to endorse their products. I'll tell you how these scams exactly work out. See, the scammers first set up unregulated trading platforms that manipulate trading conditions. They usually do this by showcasing fake and profitable trades to attract more investors. They then make it nearly impossible for users to withdraw their funds. Some of these platforms operate like Ponzi schemes. They pay returns to old investors with the money that new investors put in. Eventually, the entire system crashes and everyone loses money. Another dirty trick scammers use is routing money through fake forex trading sites to make illegal funds look legitimate. The ED also found out that money from investors who thought they were trading in forex was actually being directed into SEBI-registered AIFs or alternate investment funds in order to give these funds a clean and legal appearance. The Reserve Bank of India has repeatedly warned people about these platforms, and they have mentioned that anyone getting caught trading on them could face some serious action. But despite all of that, these platforms still survive and continue scamming lakhs and crores of Indians every day. It does not even end here. The scammers have also figured out how to exploit the digital payment ecosystem. They use illegal payment aggregators to route funds. This way, they end up creating layers of transactions, which make it almost impossible for law enforcement to trace back the original source of the money. With so many platforms still out there, what the ED has found so far is probably just the small tip of the iceberg. But the key takeaway for all of us here is, if you are thinking of trading in Forex or any other online investments, please do your homework. Make sure the platform is registered with the RBI and be careful of any promises of sky-high returns. Always be careful about where you are putting your money. Now let's move on to the third story of the day. Since the last time we discussed crude oil prices, things have changed quite a bit, and it might be for the better. Considering the fact that India imports 90% of its oil, this is something we really need to pay attention to. As of the time of this recording, WTI crude is trading at around $68 a barrel, and Brent crude is trading at about $71. To give you some context, WTI is the main benchmark for oil produced in the US. Brent, on the other hand, was originally referred to the oil from the North Sea, but today it's used as a global benchmark for light sweet crude oil. Now, the difference between these two is known as the Brent WTI spread. This spread can change based on various factors like supply-demand dynamics, geopolitical events, and transportation costs. Usually, Brent trades at a premium to WTI because of its global reach and better access to shipping routes. Now back to crude prices, the current prices are a huge fall from earlier this year when Brent was trading at around 90 US dollars. But what is causing crude prices to tumble, you might be wondering? Look, first, there are serious worries about global demand, especially from China. The world's second largest economy has been seriously struggling to keep up its growth, which is putting a lot of pressure on oil consumption. Recently, Trafigura, which is one of the world's largest commodity trading firms, said that crude prices could soon go down as much as $60 a barrel. At the same time, the co-founder of Gunvor, which is another big player in the commodities trading space, mentioned that oil's fair value should be around 70 US dollars given the current demand and supply situation. Now, adding to the bearish sentiment, the market is currently facing an oversupply situation. Even though OPEC Plus recently decided to delay their planned output hikes, there is still a lot of oil floating around in the market. Historically, though, OPEC has cut production whenever oil prices dipped below $75 in order to keep prices afloat. But the current market dynamics seem to be very tricky as compared to what it is usually. What makes things even more complicated now is the expected rise in non-OPEC production. Countries like the US, Canada, Guyana, and Brazil are all set to increase production next year, which could flood the market even further. Now, it's not just the traders who are feeling bearish. Big banks are also lowering their forecasts. To give you an instance, Morgan Stanley recently cut its oil price outlook due to worsening market concerns. They now expect oil to average around $75 a barrel. For other context, earlier this year they expected oil prices to be 85 US dollars. Interestingly though, Goldman Sachs here highlighted a very interesting angle, which is artificial intelligence. They think that AI could reduce costs in the oil industry by streamlining logistics and resource allocation. They think that streamlining could eventually lead to increased supply and lower prices. Now, this is an optimistic view, and only time will tell if it actually ends up playing out. Now, I'm sure after listening to all this long yarn, you might be wondering if it really means anything for you sitting in India. Look, the answer is it definitely does. I'll explain. For starters, lower oil prices are generally good news for India's trade balance. As one of the world's largest oil importers, India's import bill is heavily influenced by crude prices. For context, the price of oil in the Indian crude basket has dropped from 84 US dollars a barrel in July to 75 US dollars at the time of this recording. This could help India save billions on its import bill, narrow the trade deficit, and possibly even support the rupee currency. For oil companies, lower crude prices are a bit of a mixed bag. It is great for oil marketing companies like HPCL and BPCL since lower input costs could boost their profit margins. This is already very reflective in the stock market. While the Nifty 50 is up about 15% year to date, the Nifty Oil and Gas Index has jumped 34%. Lower oil prices also benefit companies heavily reliant on crude oil such as paint manufacturers, airlines, and pharma companies. But on the other hand, lower crude prices are not too great for exploration and production companies like Oil India and ONGC. This is because lower prices can squeeze their profit margins and make life really hard for them. A few key events and data releases like the OPEC and IEA's monthly reports and also China's trade data could heavily influence the oil markets in the coming few days. It'll be a great and interesting industry to keep an eye on. Moving on to the fourth and the final story of the day, let's talk about India's aspirations with corn as a fuel. Look, India, which was once a major corn exporter, is now becoming an importer, and this is due to our push for more ethanol production, especially from corn. I'll explain what's happening exactly. See, in the episode on September 3rd, I spoke about how the Indian government has allowed sugar mills to produce more ethanol from sugarcane and rice. But why ethanol? Look, there are a few key reasons. First, ethanol when mixed with petrol burns cleaner than pure petrol. This means lesser harmful emissions from vehicles. Second, India imports most of its oil. By using more ethanol as fuel, India can successfully reduce its dependence on foreign oil, save money, and improve energy security. Third, increasing demand for crops used in ethanol production can provide farmers with a stable income. Now, the government is pushing for more corn-based ethanol. First, relying only on sugarcane for ethanol is not sustainable in the long term, and corn offers an excellent alternative. Second, unlike sugarcane, which has a specific harvest season, corn can be grown and harvested at different times in various parts of India. Third, by introducing corn as ethanol feedstock, India aims to maintain a balance between sugar production for food and ethanol production for fuel. Now, thanks to this policy shift, more corn is being used for ethanol than other purposes. India earlier exported 2 to 4 million tons of corn each year, and this year they might export only about 450,000 tons, which is a huge drop. For the first time in many years, India is buying corn from other countries. We might end up importing up to 1 million tons this year. This change will have second order impacts on different groups. First, poultry farmers use corn to feed chickens. With more corn going to ethanol, the feed prices are rising and it is making it harder for them to make a profit. Second, former buyers of Indian corn like Vietnam, Bangladesh, and Nepal will now have to find newer sources of corn. Third are ethanol producers who are benefiting from the increased support for corn based ethanol. Now, the ethanol push is set to continue considering the government wants to mix 20% of ethanol with petrol by 2025-26. Currently, it is at 13%, which means the demand for corn will likely stay high. To meet this demand, India is buying corn from other countries like Myanmar and Ukraine. India is even considering making it easier and cheaper to import corn, possibly by reducing import duties. That's all the news and stories I have for you today. I hope you found this episode valuable. I'll see you tomorrow. Take care and goodbye.